Lorenzen is the CEO of Fifth Avenue Brands, a public relations firm based in New York City that focuses on finance, public policy, and technology, and is with me now. Great to have you
Thanks for
here.
having me.
Right, let's talk about the stock market.
All right.
There's been a lot of talk if we're in a bubble, particularly AI. How do you see things?
It's really interesting, especially with, I think it's 33% of the S&P is now concentrated within the Mag 7 that they're calling it within. So I think, we're seeing really high valuations on a lot of these tech companies, and NVIDIA is one of them, right? There certainly could be a bubble there. It's interesting. We're hearing from our own clients who really follow this stuff, that you have the camp of people who see that bubble is there, and they believe that we could be getting close to that precipice where the bubble pops. But then we also have clients that are seeing strong fundamentals actually underlying it, particularly on the demand side for that AI technology, that support some of the growing valuations that we're seeing in that space. So it's interesting. The market's really high. Warren Buffett's favorite indicator for the market is the ratio of total stock market capitalization to US GDP. And currently and his kind of rule is when that ratio crosses 200%, that's like a red light indicator that we're overbought
Right.
or overvalued. And we're at about 210% right now.
Oh, goodness.
And,
Okay,
and
so we're there.
there are indicators out there that would kind of imply the market is very high.
And it's tough too because AI clearly is a transformational technology, but yet you look back, the internet was too, and we saw the internet bubble crash in 2000, 2001. It took a while to get back. And now, of course, we've got Amazon and the biggest companies in the world, but it doesn't mean that we can't have a significant correction, even though the long-term story still holds.
The consensus seems to be that at some point in the next 12 to 24 months, we'll see a drawdown that's somewhere between 20% to on the extreme side, maybe 50% in equities across the board.
Oh, goodness. Well, we did see a drawdown, I believe, in the NASDAQ of like 50% or something in those early days of the dot-com.
There's a lot of echoes of 1999.
Yeah.
Right. And it's interesting. I think we'll have to wait and see.
Yeah.
Because it's so
that's the theme, right? Always in the markets, wait and see. So I guess that's part of what we're looking at next year, 2026. Are there other things on your radar screen, or maybe some things that could be a surprise that people aren't looking at?
Well, I think when you look at the broader economy, right, and you look at the labor market, you look at inflation, inflation seems to be coming into the range that the Fed tries to target, which is about it's not there yet, but it's coming down. But we are seeing a softening in the labor market, which was reflected in the rate cut that we just had a couple weeks ago. The Fed indicated that there might be 2 to 3 more rate cuts over the next few meetings. But we just had Powell come out yesterday and kind of, I wouldn't say walk back, but maybe qualify some of those comments with a more hawkish tone. So a shift in kind of the Fed's outlook or guidance on interest rate policy in the first half of the new year could be kind of a wild card, because the market's pricing in 2 to 3 more cuts. And so if we don't see those cuts, that could become a factor.
Well, we've had 2 years of gains, and we're in the third right now, that unless things completely fall apart, which is unusual to have that many years in a row without some kind of pullback. And, we'll just see what happens. I kind of thought we might see it this year, but.
The question is, how much more will the market rally before we see that pullback?
Oh, that's right.
If you're looking at a 12 to 24 month window for when that drawdown is going to happen, what happens in the interim? And Paul Tudor Jones was on CNBC last week, and he also kind of believed that pullback is coming, but also kind of suggested the market could as much as double before that drawdown comes.
Timing is everything.
Timing is
One thing we didn't talk about is gold. I mean, gold is hitting record highs. That could be a sign of something as well.
Yeah, a lot of investors see gold as a store of value. You could maybe even say the same thing about crypto to some extent, although we've saw a lot of volatility in crypto over the last 2 days. but yeah, you're seeing signs that suggest that investors are looking for stores of value. They're looking for risk-off assets, and that there might be flows that are moving out of equities.
Mm.
Uh,
What do you think of crypto?
well, I think I'm in the camp where sometime in 2026, I do think that Bitcoin could clip 200K
In
because of a lot of
2025,
2026,
okay.
2026, because of a lot of different factors, but among them, more friendly policy from the administration towards the crypto industry. But then you also have all the altcoins that have seen an extreme amount of volatility these last couple of days. There's a lot of risk there, and I think there's even a bubble within the alt space that investors should be cautious about.
Interesting. And finally, when you talk to your clients, like what are they saying about the consumer, their spending, their outlook?
Well, JP Morgan came out yesterday, and they pointed to the fact that consumer bankruptcies driven by auto debt are rising, and that can sometimes be a leading indicator of a weakening consumer. You know, a leading indicator of other bankruptcies, whether it's housing debt, credit card debt, student debt. So I think we are seeing a weakening consumer. Forecasts for holiday spending have kind of been revised down a little bit. So that's going to be important, but it seems like it's also being overshadowed right now by the rally in tech, and specifically in AI, which is largely driven by B2B business. And so you're seeing this interesting dynamic where the consumer very well might be weakening. The labor market is softening, but the market continues to rally because it's being fueled by effectively B2B technology.
Yeah.
And that seems to still have room to run.
Yeah. Well, lots of cross currents. Certainly to keep an eye on. It makes this all so interesting. Thanks for giving us your insight, Richard. And
Thanks for having me.
yes, thank you.